I think one of the main themes, of course, was the fiscal and monetary support, and we'll touch into all of them in a bit. And of course, COVID, that is still a part of our daily lives, but slowly fading away into a lesser and lesser part. So let's just dive right into it, and we can revisit those parts. So first, one of the most important ones, the growth of money. It's really unprecedented how much the amount of money in circulation grew. So here you can see M2, which is just the total dollar amounts in circulation. And in reaction to the COVID crisis here in early 2020, we've had roughly $15 trillion of M2 money supply. And today we have almost 22 trillion. So 2021 that started there still had substantially above the trend growth of money supply. And it's pretty mind-boggling to realize how much money was actually added to the system in the last couple of years, which obviously caused a lot of things in many different markets and places. So let's talk about the fiscal side. In 2021, the government spent $6.82 trillion. You can see this chart right there. Each dot represents $1 billion. So the total federal revenue right there, 4 trillion and change in the dark blue. And then this would be the amount of deficit spending that took place. So just to put that in some context, so you don't just see numbers. And comparing 2021 to different years, so you can see the total amount of deficit for the year in 2020 and 2021, very, very similar. And then you can compare them to quasi-normal years, 2018 and 2019, and you can see the amount of deficit still has been substantial. No call is complete without the barking.
This is why you get a small dog that you can carry this high. That big one you really can't do much with. You just have to kind of wait it out until it's done, right, Itai?
Pretty much how it goes. Or you give her a little pet and then she kind of stops. Sometimes.
So, high volatility night for Nikita tonight.
Okay. So let's talk about the reopening and COVID for a second. So TSA checkpoint travel numbers, even with the new variant, still averaging at 2 million passengers per day, and really not that far from pre-COVID level. So things are relatively normalizing, which is definitely a good thing. You can see this. This is the Open Door Restaurant Index. So this dashed line is what 2020 looked like. So you can see when the global lockdowns were in effect, literally a drop to negative 100%, which is unbelievable. Some recovery in 2020 and then back down. 2021 starts at negative 60%. And even with this latest variant that took a little bit of a dip, things are very, very close to pre-COVID levels as far as seated dinners and restaurant attendees, which is pretty interesting.
Is a level of 0 means everyone's open? What does that mean?
0 means that it's the same level as it was pre-pandemic, basically. So here are the total number of cases and hospitalization, just to put everybody in the same level. So we hear a lot about cases really going through the roof, which is completely true. But there's some evidence that hospitalization is finally decoupling from that and not rising at the same level. Also important to realize that because the new variant is reported as fairly mild, a lot of positive results are not even being reported because they're take-home tests. So still sort of early, but early indication and research shows that there's a lot of reason for being optimistic for the next year with the COVID situation. Okay, let's talk now about the labor market, one of the most important things that happened in 2021. So first off, the unemployment rate is back to 3.9% after that massive spike in 2020, which is really what it was prior to the pandemic. But that doesn't really tell us the full story of what's happening under the surface. And the full story is this. If you look at the labor force participation rate, meaning that the people that are actually included out of the statistics, you've seen a huge dip during COVID. And even with things being reopened and a lot of jobs that are in demand, we have not seen this number recover to pre-pandemic levels. And it's very difficult to find the right reason for why that is the case. There may be boomers that just decided to retire and they don't want to go back to the labor force. That's totally possible. Yeah. All the way to people that made a lot of money in crypto and $50,000 is enough for them to retire for a couple of years. So there's a lot of theories of what's going on, and it's probably a mix of factors, but the reality is that the labor market is very, very tight. There's a lot of job openings, but people are not rushing back into the labor force. So you see that here. There's about 10.5 million job openings right now, which you see in 2021, we've seen a huge surge of job openings. Businesses and companies are just desperate for employees and workers, and they're just not getting as many as they would like.
Itai, do we have any kind of guidance as to, of those 10 million, what is the breakdown between more blue collar jobs and maybe more white collar jobs?
Yeah, there are indicators. I don't want to get too deep into it right now, but you do see a lot of wage inflation in some of the lower end jobs as well. And there's really demand for all kinds of jobs. It's all across the board right now. And you can see that even more clearly here. So this number is really interesting. So you can see that there are currently 3.7 million job openings more than there are unemployed people. So if that statistic doesn't blow your mind, I don't know what would. But again, keep in mind that that has to do with the labor force participation rate. If the labor force participation rate went up, then the unemployment number would potentially change. Okay, we all heard a lot about supply chain issues as well. So very briefly, I'll mention it. Here you can see the companies that are reporting shortages and issues with supply chain during their earnings transcripts in 2021. Definitely a surge, which eventually led to a lot of inflation. So we see that here with the PPI. So we hear a lot about the consumer price index, or CPI, which is the end inflation that we, the consumers, face. But there's also a supply side to it, which is the producer price index, which is the inflation that producers face. So you can see that they've had 9.6% inflation on the PPI side, where goods were close to 15%. So very, very substantial inflation on that side. So that leads us to the main point of 2021, which is really that inflation. So consumer price index generally got to 6.8%, which was the highest number since the 1980s. And it's really it's hard to overstate that because, sure, some of it was because of the base case effect coming from the pandemic where things were relatively closed, and then having some of that base case effect. But still, you've seen prices like used cars, all the way to energy prices, et cetera, really, really explode. We've also seen rents. Jeremy, like what is the average rent inflation we've seen in the last year?
Well, on our personal properties, the ones within Equi, we've had 16 to 17% year-over-year growth. And I'm hearing a lot of stuff on real estate Twitter saying anywhere north of 15%, kind of across the board. Brian might have some insights on that, on rental growth, if he wants to chime in on the chat or something.
Yeah, no, I think you're right on it. It's right around that rate. The only markets, Chicago, San Francisco, New York, haven't seen that growth, but almost everywhere else in the country has been 11 to 17%. So you're right on.
Which is almost double the normal CPI. And we know that it's understated because shelter inflation is very substantial. Okay, so we know inflation is a real problem, and let's compare that with wage growth. So if you're looking at average hourly earnings going here into October, 4.9% increase versus the inflation at that time, 6.2. So real wages are still down, even with that huge wage increase that we were seeing. So the actual consumer power is declining after this big wave in inflation. So all this money supply increase and all this type of activity has contributed to some speculative behavior in some corners of the market. So let's talk about that for a second. So first, we've seen the amount of buybacks in S&P companies really, really grow. We've heard during 2020, early 2020, there was all this discussion over, but why do airlines not have enough money to support themselves? Why do they need the government? And the answer was, well, they spend it all on buying back their own stock. So if you thought that behavior changed, it did not change at all. And we actually broke records over this past quarter in the total amount of buyback that was done by S&P companies, which tends to support the price and also makes PE ratios appear lower than what they really are. But I'm not going to go too deep into that. Flows into global equity funds, if you're looking at just the rolling 50-week period in billions of dollars, about $1 trillion flow, it really just blows all the other periods out of proportion with the amount of just pure dollars into equity flows in 2021. So it's not a surprise that the year ended up, over 20% and such a strong performance for the S&P. IPOs. So over 1,000 IPOs, out of which 606 were SPACs, which are considered far more speculative. If you're looking here in the 90s, this is substantially more. Even though the 90s were for a few years in a row, 2020 saw a big increase, and then of course 2021 is just unprecedented with the amount of that kind of activity. The Goldman Sachs Not Profitable Technology Index. So take all the tech companies that are traded and are not profitable at all, buy them at the beginning of the pandemic, and 4x your money. That of course corrected quite a bit since then, but it's a sign of basically money just chasing growth, and also the pandemic closing a lot of the traditional economy, people moving more into the tech economy. This one is interesting. It's the amount of cryptocurrencies in existence. So late 2019, just shy of 3,000. A couple of months ago, 7,500 different cryptocurrencies. I wanted to start one as well. Never worked out.
I'll stake it. I got you. Itai, do you wanna at some point just take a pause and maybe open it up to some questions too? Because I know we're covering a lot of content quick.
Is that chart new cryptos, or is that just the current cryptos in existence?
It's the amount of cryptocurrencies, separate cryptocurrencies in existence. So it's not market cap, it's just their total count. How many of them do you have?
Okay. So there's 200 that went out of business between July and August.
Yeah, I would think so. Yeah, went to zero.
Either about the last chart, because it's striking, right? Is there any, where can we look up more about that index, the Goldman Sachs index that you showed?
Yeah, you would just look for the Goldman Sachs non-profitable tech index.
So how do they do this? Just like valuations on
Yeah, you actually have it. So it consists of non-profitable US listed companies in innovative industries. So they're basically just taking these broad concept of tech companies. And the only way to be included here is if you actually don't make any earnings or any profit. So the second you start actually making profits, you would be excluded out of that index.
But they're public companies, right?
Yes, public.
Oh, okay.
Yeah. Okay. So another indication is unicorns are no longer unicorns, right? They're not rare to see anymore. It used to be the case they were called unicorns because it was so rare to see one. But there are about 1,000 or so billion-dollar private companies now. And some of them are really, really big, such as Stripe. So a lot of this behavior is already tapering off since especially the Fed, and we'll talk more about that Fed pivot. The Fed started moving away from this very easy money policy. Bitcoin sensitive stocks as Bitcoin. Actually, it's interesting that it peaked ahead of Bitcoin itself. Liquid IPOs, not profitable tech has already started declining, etc. Now, this one is one of the most interesting things that I've seen, because the NASDAQ now is effectively 10 companies as far as market cap goes. I'm obviously exaggerating, but the big tech carries a ton of the weight of the index. And you don't even see a dip in the index if you're looking at this really long-term view. What's really interesting is that the way you read this chart, the blue line, 40% of stocks in the NASDAQ are actually down 50% from their 52-week high, from their recent one-year high, which is insanity. There's a full-on bear market going on underneath the surface of the indexes. So if you are not in the 10 big companies or in the index itself, it's very possible that you're down huge amounts of money. It's a complete hidden bear market. Okay, I know I covered a lot. I'll take a quick break here for questions.
So the takeaway real quick though on this slide, Itai, is that the amount of companies in tech that are down heavily is growing and growing fast. So really, like you said, hidden bear market. Yeah, hidden bear markets. You can see from the early days of 2021, it was 10% of stocks, and now it's 40. So it's crazy. It's almost half the companies in the NASDAQ are down 50%, but the index is what, 5% or so from all-time highs. So it's really crazy to be seeing this. That makes sense. So why has it stayed up that high? Why are we not seeing more falling of that index? Well, because it's not an equal weight index. It's market cap based index, and companies like Apple, that is a $3 trillion company, just carries such a big share of the market that as long as they keep moving up, they're enough to offset all the losses and keep the index up. It's just simple math, the way the index works. That makes sense. Are there any other questions too that people are getting? I know we did a lot pretty quick.
Yeah, like what is a typical company right down there? Like, because they had a peak on 2020, right? There have to be like, maybe DoorDash or like those kinds of like, like pandemic, like lockdowns related companies, you think?
Well, this was basically the whole market was down. So if you see this dip here, that was the 25-30% drop in the market. So that actually makes sense because it moves with the index. What's weird is when this is so high and the index is basically not going down. So that's basically the idea here is that if the big tech starts dropping, then it could be a really big problem for the index as a whole and for generally the equity markets. But that's we'll talk more about that in a second. Okay. So this is an interesting one. I'm sure you're all familiar with ARK Invest, which is the kind of dreamer stocks and all these high growth potential. I know you have Tesla in there very famously. So that did exceptionally well in 2020. It was one of the most famous ETFs, and it seems invincible, and it's just going to go higher. And it's actually down almost 50% from those highs. And one of the most interesting things I've seen is that the average investor that bought into ARK is actually down. Why is that? Because if you're looking at their total assets that they're holding, minus the flows that went into the ETF, it's actually below zero.
Hello.
I think we gotta do some muting of people. If you're not speaking, can you mute?
So here's my question to be louder than them. Is that the company that just moved to Sarasota, bought a building, like an incubator building and doing all that?
ARK?
Uh-huh.
I believe so. Yeah. Okay. One interesting chart that I saw, very speculative, of course, but just in the way the behavior of the masses. So you can see the ARK chart here in white versus the .com bubble in the NASDAQ itself. It's just interesting how that behavior panned out with this massive run up, top, down, up, and where it is today. Obviously, very speculative, but a little bit of food for thought there.
Itai, one of the questions that was coming through the chat was geared around those smaller companies. And it was Jackson asked this, which was, are we seeing any similar themes or similarities between the ones that are down in that bigger group, that 50%?
Yeah, they are just not fundamentally strong, and they don't have their earnings or their PE ratios and multiples are just really high. So the correction we're seeing is in those that are not as profitable for the most part, which could relate to the Fed pivot.
Got it. So less profitable companies, but then it also seems like at the same time, though, on the VC side, the early stage companies that are wildly unprofitable are running away with valuations right now.
Right. There's a little bit of a disconnect in that right now. But also think about the VC cycle, because we're still in a world awash with cash. So they're still sitting on very large amounts of cash and they still need to deploy it. So it remains to be seen kind of how all that plays out.
Okay, got it.
Okay, one of the more interesting parts of the market is the zombies. So what are zombies? They were made famous in the 1980s. There was a bubble in corporate bonds during that time, and companies were just issuing a ton of bonds. What was the issue with that? There's some types of companies that when they issue the bond, they actually don't have the money to pay the interest expenses. So how do they stay alive? They just need to feed on more and more cheap debt. So they need to issue more bonds at a better rate and then refinance those original bonds and then keep doing it again and again.
Are you talking about bonds or Social Security?
So the main problem is, of course, when you can no longer do this because the interest rates go up or something like that happens. So this is an interesting thing that I saw. If you're looking at the total enterprise value of firms, that their earnings before interest and taxes is actually less than their interest expense. It's almost $6 trillion market cap of zombie companies in the economy. So again, all this cheap money and cheap debt definitely fueled a lot of speculation in different corners of the market. So I think it is good and healthy for some of those excess to correct themselves. Okay, so let's talk about the macro. But before I do, I want to see if there's any questions about any of that.
Zombies. Let's say we see a run up in interest rates to curb some of this inflation. I mean, of that $6 trillion, how many of those companies are what percentage of that is at risk of going under?
It's a tough question. I mean, if they can't grow their earnings, some of them are just spending more because they can, and they can cut in different places so they can make those debt payments. But yeah, I mean, it could be a big problem, can cause a lot of defaults. So that's why the Fed has to tread carefully.
I'm just wondering about the companies like the cruise lines and the others that put out a bunch of bonds when the pandemic hit.
Yep.
And they financed to stay alive. If we start closing down again, a lot of these places, and then the interest rates go up, how much worse that's going to, I mean, how many times are they going to be able to come back to the till and just keep borrowing more money?
That's exactly the question. And I mean, the market cap is huge because the companies were still able to grow. Yeah, it's a good question. Okay, let's talk about the Fed pivot real quick, because I think it's one of the most important things that happened. So first of all, in late November, Powell goes to Congress and says, you know what, I was pretty much wrong about this transitory thing. It's not transitory. It's actually here for a while, and we're going to retire that word. So the writing was already on the wall in November when they did that, and we followed it quite a bit. Now, going back to Jackson Hole before, just to show you how dramatic that pivot is, when we covered it in 2020, when they were in Jackson Hole, they said that they are going to retire the 2% inflation target. I don't know if you guys remember that, but they said, we're going to allow inflation to run hotter for a while. They never defined what that was because they were so worried about deflation and disinflation for so long that they were just, you know what, even if it gets to 3%, then that's fine. And, it's eventually going to revert to that long-term 2%. So you can actually see where they retired the 2% target and followed. Sure enough, they were able to get the inflation they always wanted, and a lot more of it than they actually wanted.
Yes, they got a lot more than what was prescribed.
which kind of tells us the Fed is almost perpetually behind the curve, right? They always are reactionary to these things and they don't necessarily see it coming. Okay, so the markets are now pricing in. Goldman actually came out today. They said 4 rate hikes this year, but it's at least 3 to 4. If you're looking at the Fed funds futures, so you can see this in the CME tools, you can actually see based on market pricing, what's the probability of a rate hike in March. The probability right now is 72%. The Fed's already going to raise rates in March. So that's really, really soon. So, you know, the 180 the Fed has done right now is just crazy. I think it's one of the most dramatic pivots they've done in recent policy. So, and they're also increasing the pace of taper, which now QE is completely going to be done by March as well. So no more QE at all, and then increasing in rates starting in March. So, okay, the Fed is going to raise rates. What's the problem? We've had that before. Fed has raised rates. Markets did not break. Things were still okay. And you know what is really wrong with it? And we've seen markets actually perform well during Fed rate increases as well. And I think the problem is that the debt load now is way bigger than what it used to be. So if you're looking at the US debt to GDP today, it's at 133, 134%. And pre-pandemic, it was at about 107%. So that's a very big increase when you have to make payments on that added amount of debt. And the total interest that is being paid right now is already sitting at about $350, $360 billion per year.
Itai, so I want to ask you, because I think this is an important concept to make sure that we understand. So let's say the prevailing Fed funds interest rate doubles, okay? If we're paying right now $360 billion a year, does that mean that the debt burden for the United States now jumps up to $720 billion? If so, why is that the case? Can you just explain how it works?
Yeah, it's not necessarily that immediate because some of those interest payments are fixed. Let's say you have a 10-year, well, 10-year is floating, that you have floating rates, which you will pay more on potentially. But every time you need to issue new bonds or you need to refinance existing liabilities and corporations as well, not just government, then if rates are higher, then your new, basically your new payments are just higher. So it's not necessarily if interest rates double, it directly translates to doubling of the federal interest, but it will definitely increase it. So then imagine if the federal government brings, let's say, $4 trillion in revenue, and let's say rates do go up to 3 or 4%, hypothetically, you know, paying $1 trillion out of $4 trillion, that's a huge amount. Not that I think that would happen, but this actually tells me that the Fed then can't really raise rates too much, right? They're saying, okay, 3, 4%, but hypothetically think about it. Let's say inflation is 5% next year and the federal funds rate is at 1%. It's still negative 4% in real terms. So they're still able to inflate the debt away by 4% per year. Does that make sense?
That makes sense.
So what are they doing then in order to defeat inflation? Well, what they're doing, and that was one of the biggest pieces of news that hit last week, is that they're actually looking into turning QE, quantitative easing, into QT, which is quantitative tightening. And how are they going to do that? So let's look at what they actually said. Said many participants judged that the appropriate pace of balance sheet runoff would likely be faster than it was during the previous normalization episode. Okay, let me translate Fed speak for you. What the runoff means is basically letting those bonds expire and not reinvesting them or even potentially selling them like they did in QT. And they're saying that they're going to do it faster than they did before. And in the past, they were reducing balance sheet by up to $50 or $60 billion a month, which basically they're taking money out of circulation. So how does QE work? Basically, the Fed buys treasury securities from the government, and then they're creating money out of thin air and they're giving it to the government, and then it enters circulation. But if the Fed is reducing the balance sheet and those bonds expire and the Fed gets the principal, gets the cash, then the Fed just presses a button and that money disappears and that money is taken away from circulation. So if they can't raise rates too much because they don't want the government to have too high of an interest payment, they can reduce the balance sheet. That's the new tool. The new tool is really increase the balance sheet, decrease the balance sheet as a way to control inflation versus the traditional way we were thinking about it of raising and reducing interest rates.
How long term are these bonds though? They've been doing a lot of 5-year bonds, a lot of 5-year.
Yeah, they have everything. There's a list. They have everything from 30 to shorter term.
No, but what you're talking about is only going to happen on the shorter term stuff that's expiring now.
Correct. Or they can also sell. They're not completely in the QT in 2018. They sold bonds as well.
Itai, let's take a pause real quick. Miguel, you got a question? Nice job with the raising emoji. That made it pretty easy.
See, good, right? So,
Yeah, well played.
So I got lost with the difference actually, because I thought that was a way that very ignorant about this, right? That the way they would actually do that interest rate management was not by decreeing a rate, but by the transactions. I don't know, what are like there's a term for this, right? When you buy and sell like those bonds, right? Anyhow, what is the difference for our purposes here between decreeing an interest rate and doing this balance sheet runoff changing? Thank you.
Well, it's
a hard question, but
yeah. So increasing and decreasing interest rates is basically impacting the borrowing cost in the economy, and decreasing and increasing the balance sheet impacts the amount of money in circulation. Basically, that's really
then it would, but then it's a more indirect effect on the interest rate, right? Because of the demand supply of the.
Correct. The effect of interest rate is not as clear cut as raising and decreasing interest rates.
So Itai, they take money out of the system. They take money out of the system. Does that directly mean a decrease in M2?
No, not necessarily.
What is okay? So
it's more like they're taking the balance sheet itself out, which the balance sheet is how many securities they hold. And here's the most important chart that you'll probably see on this slide. And it basically shows you the relationship between the stock market measured by the S&P and the total assets that they have on that balance sheet, which is now $8.7 trillion. So since 2008, we've basically been living in this permanent QE world. What Japan has been living on since the 1990s, by the way. So if we want to take examples from other places. So in response to the global financial crisis, the first QE comes in, and you can see that during periods that generally speaking, the balance sheet rises, stock market does well, and it's relatively less volatile. And this was the period of time where they tried QT. So in 2018, they actually tried to normalize the balance sheet for the first time. And as that happened and the balance sheet actually declined, we went through a period of very substantial volatility up and down like all the time. December 2018, the market, I think, was down almost 20%, still being pretty volatile. And then it started causing problems in different markets like repos and other markets like that. And the Fed just decided to, right there, when it says reserve management, that was a fake or like a subversive type of QE, I would say. It was $60 billion a month, the market recouped. Then you got COVID and the balance sheet absolutely exploded in retaliation to COVID, saving mortgage-backed securities, doing all those kind of things. And really the rate of change in the balance sheet has really matched the rate of change in equities.
Itai, can I do some Itai speak for everybody here real quick to try to summarize this? So what I'm seeing here is basically, if you go back to the days of 2008, the government or the Federal Reserve goes through QE. So they print money and they make it available. They make liquidity available. And when those periods of time happen, we have a more steady, less volatile, so less up and down increase in the markets. And at each one of those purple areas, we're starting to see that type of trend. Now we get to the pink area, which is a point of quantitative tightening. So rather than pumping the system with liquidity, they're now removing cash out, and it leads to the spiking up and down. And so you're now saying like, hey, when the Fed has been printing, markets respond fairly well, the slope's going up on the graph, great. But we're now hitting a point where the inflation's run too hot. The future is basically saying we're going to start QT. Are you trying to signal that, hey, for everybody on the call, there could be more volatility coming in their portfolios?
Yes, that is definitely the risk that is increasing in 2022. And what's interesting is, so all this was available in information. In November, Powell said, okay, we're going to retire transitory. He prepared it. In the December meeting, they said, okay, we're going to increase the rate of taper and we're going to increase interest rates. But so you have to ask yourself then, last week, which was here, January 5th, 2022, it was one of the worst reactions. I think it was the worst outside of the global financial crisis to Fed minutes on record. And you have to ask yourself, well, if they said all these things, shouldn't it be priced in? Why is the market reacting so negatively to it? And it's because in those Fed minutes, they were actually talking about QT and runoff. Nowhere else up until that point, they were actually talking about this. So just because the market has gotten so used to QE and how things work with the Fed, I thought it took the market by surprise, and we've seen this kind of correction over the last few days as a result of this.
Itai, I love the question just came through on the chat. Is QT rolled out at a similar velocity to QE or different?
No, it's going to be different. If you had QT in the same velocity that you had the QE of 2020, markets would just totally collapse. So it's going to be a lot more gradual and not as intense. The difference is too, in the past, there's what's called the Fed put, right? Every time markets are down 15%, the Fed starts QE again and they lower interest rates again. But the question that we have to ask ourselves in 2022 is, if inflation is really 5-6%, the Fed can't do that. And markets, for the first time since the early 2000s, since really 2007, are potentially on their own. And we haven't seen that in a really long time.
Itai, do we have any type of insight as to how much total leverage there is in the system? Because what I'm thinking about right now is, okay, let's say we start having markets down and you get a limit down, and now all of a sudden there's margin calls, and we have margin calls triggering more sales and then forced selling that happens afterwards. I'm trying to understand how big could this cratering be if that happened.
Could be substantial, but I don't want to speculate on that right now. But we do have information on margin and the amount of margin loans. It is very high, but that doesn't necessarily mean that the markets will crash. But obviously, risks increase with this type of behavior.
Sure.
Okay, we do have some stuff to cover still. So again, the QE winner, the big QE winners were Apple, Amazon, Facebook, Google, Microsoft, Netflix, and Tesla. You can see how they have basically moved with the Fed's balance sheet quite a bit and really increased their market cap. And on the left here, you can see that what percentage the top 5 companies are of the S&P 500 itself. So in 2000, the prior top, those 5 companies were Microsoft, GE, Cisco, Intel, and Walmart. They're about 18% of the S&P. And now they're about 25% of the S&P. And the companies are Microsoft, Apple, Amazon, that's Google, and Facebook. And the craziest of them all, FANG, if it was its own country, would be the world's 3rd largest economy. Pretty wild. All right, here's another deeper look into what the QE and the QT phases look like. And what you're seeing here is, in the dark blue is the 10-year Treasury. And then in the light blue is the S&P 500. And then here in gray is the federal funds rate. So we can see that the 10-year has already moved up from those pandemic levels, potentially pricing in that the Fed fund rate itself is going to go up. But what's interesting is you can see during the QT phase, we had this volatility, but also the 10-year actually started falling ahead of the Fed actually lowering interest rates. So they're somewhat pricing that in before that happened. Now, what I find to be really, really interesting, and that's a question that we should all ask, is QE, the way it's done, the Treasury is creating new Treasury supply. The Fed is creating money out of thin air, and then they buy it, right? So it's creating demand for US Treasuries. But if you don't have QE anymore, where's the demand coming for US Treasuries? And if there's not as much demand for US Treasuries because of the central banks, can rates really go much higher, especially on that 10-year? And I think that's a really big question.
Itai, why do you care about the 10-year so much?
The 10-year is the price of everything from mortgages to, to how businesses are doing, future calculations. So you can see here another way to look at it. Here's your 10-year treasury bond sitting at around 1.5%. And it's one of the only times in history where the core CPI is substantially greater than what the 10-year yield is. Another way to think about it is that the real rate, basically that what you're getting after inflation, is very negative. And it's actually one of the most negative in history, going back here into the period of stagflation in the 1970s. So if your money is not doing 5%, 6% a year, you're really losing, right? It's another way to think about it. And when you're looking here at the break-evens versus the 10-year bond yield, it's another way to think about it. In the past, they really move in tandem. Here in 2012, 2013, both things happened. Break-evens dropped and the 10-year rose, and they eventually met. So right now, this tells you that the 10-year has a lot of room to move up, or inflation really is transitory, and eventually it will come down. Okay, before we get into the upside scenario, I know this was a lot, so I'll stop right there.
And this is a great time. What questions are on your mind as you're seeing this? Well, I'm seeing a lot of stuff in the chats that are coming through. One of the questions was, well, even though you have these low yields and the high inflation, wouldn't you still stay in the market in a situation like this? And I would pose that question to you, Itai.
Right. My answer is that timing the market could be very difficult depending on your circumstances. Diversification is typically the best option. This is one of the main reasons we started Equi, right? Because we wanted to have a better ability to diversify it in different assets and alternative assets that are not as susceptible to equity markets. Because the way I think about it is, if you're in the equity markets and that's your only bet, then you're just completely exposed to the whims of that. Where if you can diversify across more assets that are not correlated, that's really the best option.
So Itai, I'm going to ask you a question then. This is literally one of the questions that came through in the chat. Given this context, how, if at all, is Equi adjusting our positioning?
Yeah, so most of our investments are already not correlated with equity markets. And we have hedges for really both sides, where we have tail hedges for big market drawdowns as well as hedges for inflation. So we're trying to prepare ourselves for both those types of scenarios, where if markets really decide to go down, we'll not be as correlated. And you also, of course, have the other option where the Fed decides to roll this back because they get scared if the market's down 10-15%, and then inflation becomes a real problem. So I think you just have to be diversified and prepared for all the scenarios.
Got it. Thanks, Itai.
Okay, so we talked a lot about all these things that potentially impose these risks, but what could be the upside too? Because there's obviously upside is possible. So what are the best arguments for that? Back to these questions. Okay, so first is, a lot of people are aware of what I just said, and as a result, positioning is relatively light because sentiment is relatively poor. So if positioning is light, that means that it could increase. And if positioning increases amongst professionals, that could obviously cause markets to rise. Another way, and this is very short term, but another way to think about it in the short term, right? And this is something that I brought in the last call as well, when we had this dip in December. We've seen a lot of people buying puts. So this is the put to call ratio. As this is higher, that means that a lot of people are buying puts. As this is lower, that means that calls are favored to puts. So again, puts are protection for the downside. The crowd seems to like buying puts when the market's already down, and then those puts expire worthless as the market moves up from them. And we've seen that in most recent dips. So you've seen that in this dip here as well. And this is today, obviously it remains to be seen, but there is a high level of puts in there. And for now, at least, the trend is still moving upwards and has not changed from that. So how does that respond in the next days and weeks to come remains to be seen. A huge argument in favor of continued upside is that there's just a ton of cash from all the liquidity that was created, and it's still sitting in cash. So here you can see the total assets of managers for money market funds. So anywhere from Fidelity over there. And that is approximately $5 trillion. And if you have a real rate of 5%, that money is losing right now and needs to be deployed somewhere. Another interesting idea that I saw, M&A cycles. M&A cycles tend to be bullish for equities, and they tend to last between 4 to 5 years. So if you're looking at the .com M&A cycle, it really started in 1995 and it peaked famously in 2000. Then we have the 2003 to 07. We had 14 through 18 until the Fed started QT. This one, we've seen only about a couple of years. So potentially you still have some room to go if this is to continue. And then the discount argument. We talked about this big correction in the NASDAQ. Maybe that's enough, right? At some point, things become cheap enough and money is interested again, especially when you have 5 trillion of it sitting in the sidelines. So you can argue that a lot of expensive stocks are already down 50% from the highs, which could be attractive to some investors to start getting into those stocks. And again, the NASDAQ today saw one of the biggest reversals I think I've ever seen. It was down at some point 3% today, 2.7% today, and ended the day positive. It's still trending upwards. It's been relatively oversold in the last year. Every time it's gone to these levels of oversold, it did bounce back up. So we're making all these arguments, but at the same time, the trend is still trending upward. So that's the simplest of argument, where you don't want to bet against the trend until that trend reverses. And now the biggest argument of it all, inflation may have actually peaked. And the Fed said retire transitory, where they should have potentially said, yes, it is still transitory, because eventually they would have been right. If you're looking at US CPI versus crude oil, this is Brent crude year-over-year rate of change in white, and then US CPI here in blue. Even if oil was $100 this year, and it's up $20 from where it is today, CPI would still trend towards 3%. Why? Because of the base effect. A move like 2021 from $20 or $30 to $80 is very different from 80 to 100. So the rate of change is less, which means that the headline CPI is less as well. You also see that with just broad commodity prices. It's unlikely for them to move as up as they did in 2021, which means inflation may be peaking now or already have peaked. You also see that with wage growth. The expectation for wage growth based on leading indicator survey is for a 4% increase in 2022. So it's not as steep as what we've seen in 2021. And also supply chains. So everything from used cars to housing appliances is expected to completely taper by the end of this year, which would put a lot of pressure off of the PPI numbers and eventually translates into lower CPI as well. And at the same time, the market is still expecting there's about a 50% chance that the next 5 years CPI will still be over 3%. So, if you believe that inflation is not going to be that much, that trade is potentially going to pay out quite a bit.
Itai, what's the impact on this inflation going down to commodities? Does this mean we're going to see any type of pullback in their pricing?
Well, it's not necessarily that you'll see a pullback, but it could mean that the pace of acceleration on the upside is just going to slow. And it's enough for the pace to slow, for CPI to drop from where it is right now, which is really, really high, 6.8%. So, it's very likely to at least drop to 5 or 4% or even 3%, given all these effects. But it remains to be seen. So if inflation drops faster than expected, the Fed may think that it doesn't have to be as aggressive as it thinks it needs to be right now. And that could be supportive for asset prices generally. So all of this really leads to one key question. And that key question is the market still capable of trading at these high multiples? So this chart is a really interesting one. So pay attention to that. It's called the Blue Angels. And basically what it means is you can see the bands in which the S&P trades. So right now it's trading between a 20 multiple on earnings to a 22 multiple on earnings. Long-term historical for the S&P is between 14 and 16, going back years and years and years. But it also depends on the interest rate environment and a lot of other factors, right? So a lot of the growth we've seen is not necessarily because earnings have grown that much. It's because the S&P is more comfortable trading at higher multiples. So if you take, let's say 2011 as an example, it was trading between 10 and 12, which is historically cheap. So imagine earnings stayed the same, or earnings could even grow 10%, right? But if the S&P goes to trade between 14 and 16, even if earnings decided to grow, it still could correct 20 to 25%. So that's the way you should be thinking about it. So historically, S&P is very rich. It's trading at a very high range. And then the combination of all these factors, you have a lot of cash still. There's a lot of liquidity for what the Fed did before. So the key question is, are investors still okay paying that much for a unit of earning? And I think that's really the key question from all that to determine what 2022 is going to look like. Okay.
Well, that was a lot. What do you think is going to happen, Itai? Can we ask just some of your personal thoughts?
Yeah, personal thoughts. I think the year is going to be a lot more volatile than it was prior. I don't necessarily think, because of all these back and forth factors, that it's going to turn into a full-on bear market. I think it could be more like 2018, and 2018 was just volatile and choppy, up and down. Yes, it made a new high, but it also dropped at some point and it ended the year pretty much flat. I think that's very possible. And it really depends too on how inflation looks like and how the Fed reacts to it. But if I had to take a guess today, that's what I would assume could happen.
And what do you think for unprofitable tech? So maybe some of these recently IPO'd companies still burning money a few years post IPO, to understand kind of maybe what the outlook could look like for them.
Yeah, well, a lot of them corrected already quite a bit. So, I mean, unless you get into a new cycle of easing and there's more money to get deployed, I mean, obviously, if they get cheap enough and if they correct enough and their prospects are good enough, then they can obviously move back up. I mean, I think one of the things to realize is that the business itself and how the company does is very different than what they're priced at. That's a mistake a lot of people do. So I think it's also, you have to look at what each individual business looks like and analyze each company on its own as well.
Got it. All right, everybody, I'm asking the questions. I'll stop. Pepper Itai, that's the time to ask away. Alex, I know you had a question. Stop watching touchdown fumble recoveries and ask questions.
Can't help it. So, everybody's asked about risks and whatnot, and you say diversification. Yet, we've all seen in the past what happens is when things go south, correlations go to 1. So a lot of times you're diversified, but you're not diversified. So what's your take on that?
Yeah, I actually run a pretty extensive analysis just on this point. So when I talk about diversification, I'm not talking necessarily about asset classes. So for example, you've seen Bitcoin has just been very correlated to the action in the NASDAQ and non-profitable tech. So yes, there are still some assets that may have diversification benefit, like gold or treasuries or something like that. But I'm talking more about diversification of strategy. So, the way I look at it is there's certain hedge funds that trade very specific strategies or arbitrage or something like that. And I can run their their return analytics going back to previous crises and see that they're not correlated, or I can look at timeframes and different strategies. Managed futures could be some. I know you're very familiar with that. Different option strategies, private credit strategies. So I think about more diversification of strategy versus particularly asset class. You could have two funds that have totally different return because they run a different strategy on the same asset class.
So when the Fed starts like raising rates, you think they're going to be doing like 1/8%, 1/4%?
Yeah, it's a quarter point. I think the days of like a point at a time are either gone or they belong to the central bank of Turkey.
Do you think it's possible they do like a 1/16 of a point or an 1/8 as opposed to a quarter?
No, I don't think so. I think a quarter is pretty standardized right now.
Itai, how does that sideline $5 trillion factor in on all of this?
Yeah, it's just something to keep in the back of your mind that if equities or any other asset class fall, you know, a lot of people are going to see that as an opportunity. And if you have so much cash on the sideline, it could basically, imagine if you had a lot less of that and the markets decided to fall and the Fed wouldn't support them, there would be no support. But now you know that there's some money out there that could potentially support them. So I think it just reduces the overall size of how much the market can drop.
Is that why we're also seeing so much money plowing into the IPOs?
Yeah, I mean, there's just a lot of money out there. The Fed
it's got to find a home, and I think it's just going to continue in the IPOs and the buybacks.
I mean, the Fed just created so much money. So yes, they're pivoting away, but you have to realize that there is a momentum factor to all the money that was already created, which is why I'm not overly bearish.
Itai, if there's a crash in 2022, what's a reasonable worst case scenario?
I think the worst case scenario possible is that the Fed continues to get aggressive into a crash because inflation is growing even more. So imagine kind of stagflationary scenario where economic growth starts to worsen, inflation gets even higher, and the Fed says, you know, we're going to accelerate QT even further, and markets are down 20%, and then the Fed goes on the next FOMC and says, you know, we're going to accelerate QT because the inflation is just too much of a problem and the markets are already down, then that I think would be the nightmare scenario.
Got it. Everybody that's asking questions, John, do you want to ask your question aloud? I'm putting him on the spot.
Sure thing. So just on the hey, it's John. On the other side of this Fed creating money as they start to tighten, and maybe we see some QT, do we expect M2 to come down?
Not necessarily. Not necessarily. That's basically the main. It's really complex the way that all works, but QE alone is basically just recapitalizing the banks. The banks are well capitalized right now. They're also sitting on a lot of reserve. It's really the fiscal policy. It's the fiscal policy with QE that created a lot of that M2. So the fact that the QE alone is going to disappear is not necessarily going to reduce M2 directly.
Itai, how much does the fact that all these FANGs have their own like wide moats and in some cases maybe a monopoly factor into their valuations?
Oh, I think it definitely factors into their valuations. I mean, you know, people are basically making the bet that they're going to get even bigger, right? Which is interesting in a way to think about it. We're almost sitting in a new era of Standard Oil and U.S. Steel, right?
It's a new era.
That's also, by the way, a big potential risk is the regulatory risk of breakup for some of these companies.
Yeah, there was a really good podcast that Balaji had. I don't know if anybody listens to, but he was making the argument that the government actually wants to keep these monopolies, because it's as decentralization is coming, it's their only conduit for which they can actually get leverage. I have no idea if that's the case, but it was it was a very, very interesting podcast that made me think, all right, he might be thinking of something, because it would only make sense they were broken up. If they haven't been broken up yet, the answer is what, you know?
Look at how many committees they sit on, how much money funnels in, as opposed to Microsoft in the late 90s that had no representation in Washington and got in the late 90s and got the antitrust legislation. They all saw that. Now they have huge lobbying presence in DC. That's why another reason why you're not going to see it.